Have you ever wondered what makes the price of gold go up or down, or why it seems to be in the news so much during uncertain times? Well, the simple and direct answer is that gold prices, just like the prices of most other goods and services, are fundamentally driven by the classic economic principles of supply and demand. When more people want gold than is readily available, its price tends to rise, and conversely, if there is a surplus of gold and less interest in buying it, the price typically falls. The core mechanism behind this lies in the factors that influence both gold's availability and people's desire to own it. On the supply side, the amount of gold entering the market largely comes from new mining output, which is a relatively slow and costly process. It also includes gold that is recycled from old jewelry or electronics, and occasionally, sales from central bank reserves. Because mining takes years to develop and gold is virtually indestructible, the overall supply tends to be quite stable and inelastic, meaning it does not react quickly to price changes. On the demand side, several key elements are at play. A significant portion of demand comes from investment purposes, with gold often viewed as a safe haven asset during economic uncertainty or as a hedge against inflation. Industrial uses, especially in electronics and dentistry, also contribute, as does global demand for jewelry. Central banks also frequently buy gold to diversify their national reserves. Changes in any of these areas can have a substantial impact on the demand for gold. So, how can you use this information? By paying attention to global economic news, interest rate changes, and geopolitical events, you can better understand potential shifts in both gold's supply and demand. For example, during periods of high inflation or market volatility, investor demand for gold as a safe haven asset often surges, pushing prices higher. Conversely, a strong economy and rising interest rates might make other investments, like bonds, more attractive, potentially reducing demand for gold. One insider detail that makes gold unique is its role as a non-yielding asset, meaning it does not pay dividends or interest like stocks and bonds. This characteristic significantly influences investor demand, as its value is primarily derived from its perceived scarcity and its ability to store value over time, especially when faith in traditional currencies or financial systems wanes. It is not just about its industrial applications. It is deeply tied to human psychology and financial stability concerns. Ultimately, understanding the push and pull of supply and demand allows you to see the bigger picture of gold's market movements. This knowledge empowers you to make more informed decisions about whether gold fits into your investment strategy, helping you to potentially protect your money from various market risks, rather than just reacting to price changes without context.